Good afternoon, traders. This is Taylor from thetradinganalyst.com. Thanks for stopping by. We're going to take a look at the S&P 500 chart. We're going to dive deep into it and look at a lot of levels and show what we're seeing and what we saw last week that prepared us for this move to the downside on Friday. But first, if you're not already a member, go ahead and visit the home page of the website, www.thetradinganalyst.com, and start your 100% free 7-day trial today. All you need to do is enter in your name and your email address, and you're going to get instant access to the live broadcasts, chat room, daily watch lists, daily webinars, and an education from mentors like myself who truly care about your success. You're also going to be able to take part in the profitable trade alerts, which will not only make you money in the market, you have an opportunity to learn while you earn from the mentors like myself. It's a great opportunity, and we'll see you over there. All right, so let's get into the S&P 500 chart. So as I mentioned last week, on Thursday, we saw some opportunity for some downside. Now, why did we see that? Okay, we saw that because of this rising wedge pattern here. You can see it on the daily chart. You can see it even better on the hourly chart here. So here are the lows here, trend line here, trend line here, trend line here. So now what was a signal that there was going to be some potential weakness here? Well, you've got two things here. You've got MACD, which was showing a negative divergence. All right, so what do I mean by negative divergence? Well, as price was heading higher, so you can see here is price, okay, and then here is MACD. MACD is the red line, and the blue line is the signal line. So MACD made a high here, and then as you can see, as price is heading higher, we've got MACD that's heading lower, and then here we crossed back over positive, but we made a lower high. So here's a higher high on price compared to this high, and then over here we have MACD, which made a high over here and then a lower high. So as price went higher, MACD went lower. So that's a negative divergence. And also RSI did the exact same thing. RSI is the green line, and as you can see, here was a high over here, made some highs, and then we made some lower highs over here. All right, so we saw some negative divergence, and that's exactly what you want to see when you're preparing for a rising wedge breakdown. So that's what we saw. Another thing that we saw is, as you can see here, we had a shooting star doji right here on this candle. Okay, so that's a potential reversal signal. Okay, we noted that signal there on Tuesday. I believe this was the day. Yep, Tuesday. We noted that. The following day, we stayed within the range of that shooting star doji. Okay, so the high over here, we were not able to close over the high. I think we closed right at the high of the previous shooting star doji. I think over it by 1 cent. So the high over here, 212.34. And the close of this day, 212.37. So 3 cents over it. In my book, that's not enough to consider it a close above it. So it stayed within that range. Following day, we made a lower high and a lower low, and we went below not only the day before's low, but the previous day's low right there, and made a lower high. So this was a break out of the falling wedge, and we also closed lower as well as made a lower high and lower low. So that right there was the signal that we mentioned for lower prices. Moving forward on a larger scale here for the S&P 500, same thing that we saw on the hourly chart that we're seeing on the daily chart as far as the MACD and RSI negative divergence. Here we have a high on MACD. All right? Over here we have a high on price. Over here, we have a lower high on MACD, but we have a higher high on price. Okay, now I just want to throw this out there that you should not make trades based off of just the MACD or the RSI. Okay, you really want price to show you where it's headed. Price and patterns on the chart. Okay, so going back to that hourly divergence, okay, getting short up there just based off of this MACD divergence and this RSI divergence, not recommended. But on this day right here, this day was when you should have gone short, because not only did you have those negative divergences on the indicators, but you had a breakout of those patterns, as well as a breakout of those that rising wedge, as well as a lower low and a lower high. Okay, so that's what you want to look for. So now moving forward, what do we see on the S&P 500? So what we have here on the hourly chart here is we have a morning star pattern here on the hourly chart for the S&P 500. So we've got a red candle here, we've got a hammer candle here, and then we've got a green follow-through candle here with a lot of volume. So I suspect we can potentially see a little bit of a bounce on the S&P 500. But more importantly, how I would personally play this is short it on a gap fill up here near 212. We've got this gap that still needs to fill. If we get a bounce, I think it's safe to say that shorting in the 212 to 212.40 range is a great risk reward. Okay, we're at least going to be trading, in my opinion, in a range up here before potentially making a move higher or lower. But more probable is either going to be a range trade up here between 212.40 and 209, or some downside on a break below that 209. We've been in an incredible uptrend, and we need to, at the very least, see some consolidation here in the market. Okay, I'm not talking about a crash. I'm not talking about a big move to the lows down here. Let's just take it one step at a time. Right now, I see that up here is a pretty good risk reward to short. And I look at a lot of charts in the market. I look at every single individual component of the S&P 500 as well as the Dow. And when I'm looking at that, the eye test shows me that we are seeing some actual weakness in the market, and a little bit more than what the S&P 500 ETF is showing us here. So we're seeing a little bit of weakness, under the hood of the S&P 500. So just be kind of aware of that. And if you want to look at all those charts yourself, I would highly recommend it, and you can get a really good feel for the pulse of the market, and you can see where the market is headed with greater certainty than just looking at the S&P 500. So in addition to these highs being shortable, we've got the biggest support that I see that's near us right now on the S&P 500 is this 209 level right here. So I'm going to go to the 15-minute chart, and I'm going to show you can see it a little bit better why this 209 level is a good support. So look at this 15-minute chart, and you can see how many times we've bounced off of here. This is a great long trade right here that we were able to participate. The members in the site were able to participate in last week off of that bounce here. I suspect that if we touch it again, that we could get another bounce. Okay, so realize this is a really nice support at 209. So biggest support I'm seeing is 209. Biggest resistance is right up here around 212. So we've got that gap to fill around 212 right here, and we've got support at 209. So pay attention to these ranges, and you're going to do just fine this week. All right, guys, thank you for stopping by thetradinganalyst.com. I appreciate it, as always. Again, if you're not already a member, go ahead and sign up here for the 100% free 7-day trial today. You're going to be able to get immediate access to all of the member benefits that we mentioned before. Name and email address, and you're in. It's a great opportunity, and we'd love to have you.